Good morning and welcome to Equity Story, Wednesday, the 22nd of March. Here with Claude. We are obviously going to have a little sesh today, talking some stocks, having our little sesh on thought of the week. And we've got a couple of different things we're going to talk about, which will come in a moment. Before I go on any further, the disclaimer in front of you. Of course, everything we talk about today, every story, is general in nature. We only take into consideration the actual fundamentals and technicals only. Now, welcome, Claude. I saw that last night we had a little bit more settled markets. We had green in the US, which was nice. So the little fires have been put out by the Fed, by Europe, and so on. Let's hope it continues that way. However, I'm still quite nervous what else can happen. So going back to here in Australia, I am just looking at our market, which has started positively. But I'm also looking what is actually happened news-wise, right? So there hasn't been too much this morning to get excited about. I've only got one story quickly, which I'll go through, which I'll mention, which come out with the update, like not an update, more like a presentation. But I just want to bring it to everyone's attention again, because it's one of our stories that we've got on our portfolio. That's IGL, that's IVE Group. So let me just share that with you, and you can see the actual story itself. So here we go. Now, I'm going to go jump into the actual page where it says dividends, capital management, and outlook. That's all we're interested in. We know they've delivered a pretty good result. So FY22 NPAT was 33.1 million. Current FY23 NPAT guidance is 41. That excludes the 3.9 mil I think they're going to lose on its Lasoo investments. So let's say 4 million of that's 37, still about 10% NPAT growth, which is nice. So for me, still not a bad little growth company. And if you add the dividend to that, I think you've got a decent proposition here for further share price appreciation in FY23. So I like this company. You know, it's trading quite well. So I'm going to go to the chart straight away so I can show it to you. And that's why we like it, I suppose. It's got that fundamentals, the charts, the dividends. So you can probably make a case for all three overall. And you'll see that in a sec when I put that in. And there you go. So it's come back to the trend line. It's probably a good opportunity actually probably pick this up, because you can see previous behavior of this stock is up, back to the trend line, up, back to the trend line, up, back to the trend line. Well, hopefully that's going to happen the same again here. So that's the one that's come up with the update today. Now, Claude, without further ado, because really there's not much to talk about company news-wise, let's jump in straight away into our thought of the week. And look, a little bit messy from me because I couldn't think of anything. So I've asked you to have a look at what are you looking at the moment. And you've come up with a pretty interesting idea, and that is the stories you are going to be definitely looking to jump back into when things settle down and maybe when the charts start looking good. So I'm going to let you go first, and I'll talk about mine in a second. So please, let's have a look at the stories that you pretty much like and you're hoping to get back into it when the time comes.
Yeah, no worries. Well, for you, as we were saying, there are like a few different categories of stocks I'm looking at the moment. I'm always looking at these ones. These are my favorites. It could be when the market looks more constructive. So certainly if I got convinced that we're in a lower interest rate regime now, or at least stable, that would make me want to pay up for these guys. So it's not just the chart or just anything. There are a few things. It could be the chart looks nice, the setup. Some of them come down a little bit, others haven't. If they came down enough, I'd probably buy it despite a terrible chart. But anyway, the first one I want to talk about is DTL, Data3. Now, this is a real class company. Yes, it's getting a new CFO, but their long-serving CFO has been there like 30 years. So for once, I just don't think that's an issue. Obviously, it's a pity to lose the guy, but I don't think it's like he's jumping ship because he thinks it's about to sink. He's been there for a really long time. And yeah, look, as you say there, probably the chart's looking all right still. And I wouldn't hate being in this one right now. It was one I owned. It's one I have followed for many years. I had no problem with owning it. I sold it because it's not an official rec, but definitely this is saying the one that comes to mind first of all when you're like, Claude, what are you looking to jump back into? Yeah, well, I'm looking to jump back into DTL. It's a matter of, can I get it for a decent price? This now current price is a lot higher than what I paid for it. We're actually bought in. So where I started first recommending it was under $2. That was for Motley Fool days.
So that would have been back around 2016, 17, somewhere there.
Yeah. Yeah, luckily my 2016, I think it was actually. I'm not sure. It could have been 17. Anyway, my father-in-law has had it since those days.
Oof.
But yeah, I only jumped in when it jumped down there to $4.50 back in June, which was crazy. And the reason I finally got that opportunity is because I've been watching this thing jealously for so long. And finally, I'm like, oh, damn, it's under my valuation. So that's where I'm going to buy with confidence. Okay, it doesn't have to go down to $4.50, but below the current price is where I need to buy with confidence in valuation. But one would be tempted anyway, because it's not that I think it's massively overvalued. I just think that it's probably like, the share price is probably reflecting its value fairly fully. So there's not necessarily that undervalued there. These guys, what do I like about them? Well, basically, these guys have a great reputation in government procurement for IT services. And so I think the general trend over the years has been for, unfortunately, well, I don't know if it's unfortunate or fortunate, but the reality is that bureaucracies in Canberra, and I know this because it's like my friends' lives, it's half of their careers, is to have moved IT capability from the actual government department and start outsourcing that to other companies. Like Data3 is one of the biggest in there. And the reality is that this is more expensive for the government because there's an equity holder layer now that's getting a profit on basic government IT spend. And the way it works is somebody who gets to a procurement stage in the government, because there will be someone in the government who's making that decision whether it goes to, Data3 or some other company, then that person at the end of it, or even after 1 or 2 years, or even whilst they're still in that role, they're going to be constantly getting job offers for higher paid, better jobs from like Data3 or whoever it is. And I feel like that's probably that way that company's like way of signaling, hey, like, keep giving us things and you've got a sweet next step, if you want an out. Now, I'm not saying that's what Data3 is doing, and who knows, it's probably all totally innocent. They just met the person through work. They really admire them. They'd love to have them on their team. That's exactly how these things happen. So it's all fine. It's all above board, but it does lock in. It creates a lock-in because if you're a procurement officer, do you want to like get the job offer from Data3 or do you want to get it from some like unknown random little one? So for that reason, they have this sort of safety thing. It's the best interest of the decision makers to just keep choosing them. And I think that's super powerful. And I don't know if it would allow for excess margins, but they're not getting excess margins. They get tiny little thin margins, right? So that's the moat. Like your tiny little thin margins, you got sale, you got a reputation. When you got such tiny margins, you don't really need a very big moat to keep people out because the size of the prize is bad. Like, yay, you got a 1.5% margin business. Like, you don't need much of a moat for people not to want to compete against that. So for that reason, if we zoomed right out and saw the 10-year, 20-year, I have no reason to believe it won't continue going that way. The big risk being there's, the CEO is very long serving, the CFO is gone. Like there could be this changing of the guard. There can be a situation where actually the reason we've had a great run over 15, 20 years is because they've had a great team in there and the team's retiring. So you take some risk there.
Now, I love what you said just then before about DTL. So first of all, technically it looks great, right? You've got, long-term fantastic. It's actually come back to the trend line. So possibly an opportunity to actually start nibbling on some, right? Coming to the trend lines. I love the fact that you said it's got small margins, but it's been going quite well. I mean, what a great management then, right? That they can actually look at the share price with a small margin business and they're still going great guns. So for me, that's a huge plus for the management team. The other thing is obviously on a roll, delivering some extraordinary profits. So that's brilliant. So look, I agree with you. I think this is very good, very, very good. And yeah, I'd be looking at it, but just have a look at the end of the week and see where we are at with this one. Over to the next one.
What was the bring it up? What was the next one on the list? I can't remember the order. Was it ALU? Yeah. Okay, so this is another one. Obviously, we've got a free article on the website, A Rich Life, about this. So if you just Google LTM A Rich Life, you can find out more about this one. I think the same's true of Data3 actually, but not sure about that. Data3 is more paywalled. But yeah, Altium is just a high quality software business. It is currently going through a process where increasingly it's trying to move license sales more to a subscription revenue. That tends to put a blanket on revenue growth for a while there, but doesn't actually mean that, you know, the underlying growth of the business is kind of better than the revenue growth suggests. So it has some weaknesses as well. Like it's got a lot of business in China, which can go away at any point. And it's far from perfect, but yeah, it's building a high quality business. It has elements of its business that are, I guess, like going to naturally scale up over time. It's going to be a little bit pro-cyclical because the number of seats a company needs to do this sort of chip design software stuff will depend on, how much is getting designed, how much innovation is happening, all that kind of thing. However, it's pretty obvious that in this kind of electronic, the world of electronics and electronics design, there is clearly tension between the countries to continue being the best at this kind of thing. That's in weapons, that's in telecommunications, that's in Wi-Fi, that's in all your devices, the Internet of Things, everything. So it's got a good, massive long-term trend there as well, similar to Data3. The digitization kind of trend is still real. And these guys are a little more pro-cyclical in that trend. So yeah, want to kind of buy it on a down, basically. But still, I wouldn't be again opposed to just buying some and holding it either. Just keeping in mind that as it's a high PE stock, high interest rates or jitters or whatever could see it sell off on valuation.
All right, so with this one, the chart is pretty good, actually. It's come back to the trend. It's been going sideways, but very volatile with the tech sell-off and tech bounce and so on, right? So again, I love the story. I love ET. I love this one. Again, I probably would agree with you. I want to probably own it sometime in the future.
I definitely regret not buying this one in June. I should have bought it.
Yeah, when it went down to what, 26 or something like that.
Yeah, exactly.
Yeah, but look, at the end of the day, I think we'll probably still have another chance here. If we believe it long term, I think probably we should keep going. But I agree with you. Look, let's just wait till the end of the week, see what happens. I'd say probably this one less, buying now, waiting for a bit more clarity.
In valuation, it's a little more stretched than Data3 as well. But I do think it's a better quality business than Data3 just because it does have those higher margins. So
Agree.
It's a tough one.
All right, let's move on to the next one. PWH, please.
Yeah, so this is another one, completely different kind of business, but also a high quality business with sort of, genuine IP that allows it to have like quite high margins for, a manufacturer. And I did see a little bit of director buying, just a small buy recently. And the real issue with this is it's coming down because its profit was up just 3% in the last half, or 4% rather, 3.8%. Revenue was up 15.5%, probably a better guide to the underlying sort of demand growth the business experienced. But, this kind of business, it's going to always have its ups and downs in terms of margin, depending on like a number of different factors. And yeah, like it's basically investing in growth overseas and here and trying to like win new contracts, et cetera, et cetera. It's an uneven flow of how everything happens. You do want to be seeing that revenue growth, but in terms of getting those margins right, it's basically the CEO said on the call, we'll see a big clawback in the second half. It implied that margin's going to rebound strongly in the second half. Okay, so, well, changes due to product sales mix, investment in customer engagement and marketing, cybersecurity, enterprise resource planning, system development, increases in headcount, labor rates, insurance premiums, right? So it seems like inflation got them, right? And also maybe a few other factors. What they're saying is it rebounds in the second half. That means we're going to see a stronger second half. That makes me want to buy, quite frankly. And the only problem is if you just look on face value, the growth rate's not there for the multiple. But I'm like, even if it doesn't rebound perfectly next half, I wouldn't say that it's never going to rebound. Problem is P 45, dividend yield 1.2%. If anyone just looks at that 4% growth and sees that PE ratio, they're going to be like, oh, what the hell? And on top of that, you're obviously pricing for this rebound in the second half. And we've all heard, don't worry, it's a stronger second half many times in our lives. And I'd say at least 2/3 of the time it's not better in the second half or not better enough. So that's why, you sort of been burnt trusting on that second half so many times as an investor over the years. One is cautious about that particular thesis. So I feel like it would be tempted, but definitely one I'm looking to get. And maybe I think, as we were saying last night, just want that price a bit lower.
Yeah, and I think the investors agree with you here. I think they're a little bit skeptical, and they're probably thinking this is too expensive for the growth we've seen. So maybe they'll come back if they do deliver that second half what they've promised. So technically speaking, Claude, if you're looking to get into this, you can either try a little nibble at 9. I'm looking at the monthly, right, which is the long-term charts that we normally put on. So either the 9 or 766. You can see previously over a long period of time, it bounces off that black line quite nicely on the monthly, and that 766 would be probably my cheeky buy if I wanted to buy, and that gives you maybe IP maybe around 30, something around there, which would be much more I suppose palatable for me as an investor.
Yeah, it's definitely easy to make those numbers work around $8.
Absolutely. So that's what we'd be
even when I last valued it, I had it under $6, which was probably a little bit too harsh in hindsight, but I think, like it's definitely ran away from me in terms of valuation. I think it's come up since then, but yeah, still.
But I think patience will pay off here if you're looking to purchase this up, because it's now broken the shorter term, the weekly trends, right? So it looks like it is definitely going down to that $9 at the first one, maybe 877, and maybe even below that, because again, we've seen it, it's a little bit volatile. I love the story. I've actually got this in the portfolio. I've got a very small amount, right?
It's crazy that it went from 6. It went from 6 to 12 in like 6 months.
Exactly. So, it's just normal. It's coming back. I'm not too worried the business side. I am just thinking for the traders out there, you probably want to get out of this and come back to it when it starts rebounding. And the thing is, like I said, it could come back to that $7.58 before it rebounds. So just be careful. Long term, nothing to worry about really. It's still above trend. All right. Next one is FID. Go on.
I won't labor on this one just because being a funds manager, it's not exactly the kind of the cycle, the part of the cycle where you necessarily do want to jump into a funds manager. This is a good little funds manager, it has a great track record, put it that way. The founder and CEO both actively have, own shares and buy shares. I believe there's good alignment on this business. I believe that the management is a good team, honest, competent, would love to back them. Price isn't insane, probably not that attractive to be buying a funds manager right now, but financial advice, funds manager, vertical integration stuff there. Obviously you have some regulatory risk, generally speaking, unless it's Australian ethical, it's never going to trade on 50 times earnings, but it can probably over the long term continue to grow its earnings. And indeed that, if you look at the 10-year or something, that has been driven by growing earnings and growing funds under management and growing network and all that sort of stuff. So definitely just a high quality management team with a decent quality business, currently trading around 14.5 times earnings, 4.8% dividend yield seems about right for me. So not jumping over myself on valuation, but at the right value or at the right time in the cycle, I definitely would love to actually back these guys. I've owned them in the past, but I've never really sort of strongly backed them for a long period of time, which is how I could have made money. So that, they're one that I would like to buy and then just hold on.
Look, and I think you, again, spot on here. Long-term management seems to be very competent because it's had a very nice rise over the last 5-6 years. And again, once again, I agree with you. Cyclically, maybe not the right time to get in right now. Just want to probably see that market settle first, and technically speaking, probably over $7 before start looking at it again. But definitely, I can see you making a good case for this one. All right, let's move on to the next one, and that is 88, which I do also love. So let's go for it. Go.
Yep. So another, just like this is again, shoots up the way better quality than Fiducian in terms of the quality of its business, assuming that the thesis is correct, that it's building essentially a monopoly in these sound chips that have to go into almost anything that's network sound. So that's the thesis, makes sense. All of the data we've seen over the years continue to suggest that's true. in terms of it actually is building a sneaky monopoly. It obviously hasn't put its foot on the accelerator in terms of profit just yet. It's using all of its profits to try and grow into other things such as video, et cetera, and more of a software offering as well. It makes sense. You got this little niche that you're kind of dominant in. You don't want to like immediately be like, right, let's start profiteering as hard as we can. And all of our customers can look at us and we're like, sitting there with 25% profit margins. Kind of makes sense if you just actually use that money to like build and invest in more growth. Oh, look, we're losing money ourselves kind of thing. You guys are really getting the better of us. And probably maybe build something better in the end there. Also founder involvement with this one. So nice little business. Like not easy for me to like make the valuation stack up, but it's just one of those like super wide range of outcome situations. Like, yeah, if the bull case is really true, the valuation's fine now. But like, if this just turns out to be like a normal, decent business, which is also quite possible, then the valuation's already pretty stretched.
Yeah, and I think technically speaking, it looks like it's going sideways. It's still a decent chart, but it looks like probably sideways, looking for that stability in maybe tech before it starts going off again. The numbers.
And it can also have its ups and downs. So obviously, the pandemic was quite a thing that happened, but even so, then it goes down when that happens. So it shows it's not really recurring business. Ultimately, its customers need to keep on ordering and ordering more product.
Yeah, so I love the fact that it is a monopoly almost pretty much in this global market. So one, I've got on my watch list too, Claude. So definitely wouldn't get a big. I remember we picked it up around $2, I think, in the early days. Rode it all the way to about $8-9. So that's been a very successful story for us, but we haven't been in it obviously recently because of the volatility, and it hasn't been trading fantastically well. But at the moment, not too bad. Just got to be patient with it. And if you're in it, hold. If you're not in it, maybe just have some patience. And let's see if the markets start to head up again. All right, next one, and that's the last one for you is RUL. This is the last stop on your list. Tell me about RUL, please.
Yeah, so initially recommended this at 40 cents right at the beginning of its journey for Motley Fool Hidden Gems, followed it ever since. Mm-hmm. And it's just ticked all the right boxes in terms of management has my confidence, as honest, or I don't know, the actual communication is pretty bad. They're honest, but they don't really give very good information or enough information to overall shareholders. Real chase up. Like, I've gotten a reply from the CEO before and I've emailed him like, well, it's not impossible to get answers and they talk to people, but I wouldn't say it's easy, and I wouldn't say that they're like really doing a great job in terms of making it easy for like shareholders to follow along. But overall, the actual company seems to be doing pretty well. And obviously, right now, what's happened is they've cut their guidance, they've missed their guidance, and they'd only just started giving guidance. So I don't know what's going on there. They didn't really need to give the guidance. I have no idea what's going on. They have like communication problems. The actual business itself, like notwithstanding the guidance is cut, is still on a growth trajectory, still doing really quite well. And they're buying back shares. So their communications might be suboptimal, but their actions are looking pretty good and also showing like confidence in the business by continuing to buy back shares. Looks like, yeah, I mean, they should. The problem is as well, is like they keep giving a bit to guidance. It makes me want to like pummel myself in the face. It's not the only company that does this, but you're a loss-making company giving a bit to guidance. It's just an absolute recipe for you pissing people off, because they're going to think that you're going to be profitable. Then they're like, oh yeah, we're a bit to positive, but still like pissing away tons of money. It's not that good. It's not a good way to treat people, and it's not clever. And it's like they're trying to facilitate. I don't know what they're doing. It's crazy stuff. These guys could have a higher share price, in my opinion, if their communications were better. But maybe therein lies the opportunity. Like, bit on the nose, or you're giving annoying guidance. We thought you're going to be profitable. You're not. Your revenue's coming in lower. You're saying the second half is going to be heaps stronger. That's that old chestnut again. So overall, still like actually the business quite like it. Probably one that I'm quite interested in. But yeah, what maybe does make me back is just, again, like I'm not a super fan of the management communication style, and feel like that they can jerk people around a little bit with like not getting a good picture of the business.
Fair enough. And look, I can see you love the underlying business, but obviously management has been sort of, I don't know, maybe having a few missteps.
I think it's mostly communication style missteps. Like, because if you actually track how they've been transforming the business in the time that I've watched it, they really have transformed that business. It's looking way healthier and better today than it was 5-10 years ago when I started following it, like really much better. So they're doing a good job in terms of making it a more resilient business. And you would think that in the next few years, they will actually become quite profitable.
And look, I can see it long term. And I think also the problem recently was the downgrade, right? That's the fall in the share price right here. And it, unfortunately, it possibly could take a little bit of time before we still see that investors return to it, if they can deliver something of a better second half, or at least something that they can actually claim that they've, improved in a way. So I think technically speaking, you wouldn't be touching this at the moment. I can see long term, you can definitely make a case that it looks now much cheaper than it was before.
Yeah.
But
I feel like it's the kind of stock that I keep on being like, all right, I'll buy it when you guys are like, oh, the chart's terrible. I'm like, I think the valuation's good, guys, and buy it, and then it just keeps going down. I'm like,
there's a fight between the value analyst and the technical analyst for me. It's something, I like it, but I'm gonna wait.
It's like, I just don't know, is the catalyst for the share price to go? The way I can convince myself not to buy it is I don't necessarily see the catalyst for the share price to be stronger. And the other thing is, if we look at it short term, say the next results, which they're saying is going to look stronger in the second half. And also, by the way, they always have better cash flow in the second half. So I bet you it will be heaps stronger in terms of the cash flow. But we'll see that. If that comes in well, I'm thinking the share price might go up back to $1.50, $1.60, but you've got that thesis on track more in terms of this does get profitable in the next couple of years.
Mm-hmm.
Whereas if it does come in below on EBITDA, then that's going to damage management credibility even further. They're already missing their revenue. And also if cash flow was weak, I would be worried about the business at that point, but I don't think that the cash flow will be weak. I think it will be strong.
So I think what you're saying is wait till the August report and then make a decision where we go.
Yeah, look, there's some chance that August report, the markets are hot there and by then and they actually come in ahead or something and it goes straight back to $1.80 or $2 and you've kind of missed that opportunity. That's possible. But yeah, I think probably, you don't have to pat all the fluffy dogs. So I think I'm probably, this is the one I'm excited about. I'm like I want to be ready to pull the trigger on this one, but I just want to see the results in the second half because they kind of already disappointed once. So we really don't need another disappointment.
And that's, I think probably for investors, that's probably they don't want to see that again. So I think technically speaking, to be honest, Claude, I'd rather let that 40 cents go, right? And I'd rather buy it at $1.80, right? With a view for long term, then I can take it from $1.80 to say $3, $4 if it's a good story again.
Yeah.
That's from $1.40, maybe going back to $1 if they disappoint again, right?
Yeah. But I mean, if the next 5 years are like the last 5 years, it's not unreasonable to suggest you do get to $3.
Exactly. So I think wait. I think this is probably the bottom of the list of yours for myself anyway. Thinking, okay, just patient with this one.
It's probably, I don't know if it's the bottom of the list for me, but it's hard to say. I think, it's not the top anyway, put it that way.
Okay, fair enough. All right, thank you so much. Bloody nice 6 stocks you've got there. So thank you. We put it. Remember, everyone, put it on your watch list.
Thanks for the opportunity to pitch you guys some of my favorite businesses on the ASX. I'm sorry, I'm not like buying it today, but I think these are good ones to put on your watch list.
Yeah, absolutely. Look, we love the watch list. Our watch list, we look at it, almost review it on a daily basis. So that's all good. All right, let me go now with my idea. And now look, I'm going to just cut it short to just looking at one thing. And I am going to make a case for Woodside today. And there's a reason for that. And I know sounds like I'm pretty mad because I'm not a big investor into the oil and gas space, right? Because it can be volatile. It can be, in a way, unpredictable. And long term, you can see it go sideways for a long time. But listen to me out, and you can obviously make up your own case here. And the reason why I'm looking at it is because it's come down to the trend lines, right? $30. It bounced off. It's now 32. It's the dividend that I'm really probably more interested in because it pays a pretty strong dividend, and it's been paying a strong dividend for some time now. And I think it can continue with that, with the fairly predictable cash flows now these days. With the assets that they've got at the moment. But I love the long-term assets they've got. So I'm going to talk about the company itself of what they've delivered and what they're going to deliver in the future. So let me show you WDS and why I think this is a great opportunity right now to get into it when it's down, right? So they've got a presentation here. So just let me get this up so you can see. So bear with me for 1 sec and I'll show you the numbers. And this is why I'm thinking, what an opportunity. All right, so here we go. They delivered obviously fantastic result, right? So that's the first thing. So if I go down to the presentation, you've got here, where is it? Go down, captured. So they've got growth. That's one thing I'm looking at. So they've got Sangoma, 77% split target of first order in 2023, right? So they've got growth coming up as well, which is something that's very, very important. If you're looking in that space of mining, you want to see a company that's got some growth projects ahead where you can see their revenue is going to grow, not just because of the oil price or whatever commodity price going up. You want to see their own assets grow with upgrades, production upgrades, and so on, right? Or new assets coming online. So that's why I'm getting pretty interested in Woodside. They do have that optionality. Scarborough is another one, 25% complete. 2026 is their first money to come through for that. So I am going to look at here and I'll show you. Hang on, here we go. Where is it? I saw that. Here we go. We've got FY22, the difference, huge, right? So that's the first thing. Incredible cash flows, 6 billion odd. NPAT was huge. They've paid out a massive dividend as well. Earnings per share huge. Can I replicate that? Maybe not, but still, like I said, I'm looking for, because of the oil price, I'm looking still for some sort of stability in this. And if you see the actual production profile, and this is where I'm going thinking, okay, they can actually deliver something fairly good next year. And you'll see that in a sec. And we've got that. First of all, margins are unbelievable as well. You can see there as well. But here we go. I'm coming at Outlook. This is what I wanted to look at. Core projects. Where are we? Here we go. All right. Full year 2023 guidance. 180 to 190 million barrels per hour. They've only delivered about 157 this year. So that's a massive increase in production, right? Remember, they've also got the assets from BHP recently as well. So that's going to add significant volumes to there. You've got fairly good pricing. If I'm looking at oil and gas, it's come down, right? Which is actually in a way good because it's come down to some sort of support levels on the oil and gas side of things. So at least I think minimal possibly risk downside to it. If it was trading, probably about $100 oil per barrel, I'd be more worried that there's going to be much more significant downside. But now it's around 70, 68 odd. I'm much more comfortable with it. Even if there's a recession, I think possibly for me, downside is probably about 50, right? On a recession type environment. Since they've got a long-term long-dated contracts out there, it shouldn't affect them too much. Saying that, they probably still may be affected, but I love what they're saying here in the full year guidance. And what they presented is, first of all, there's underinvestment in this space. So that's quality companies with quality assets, which Woodside definitely is. They should be still fairly defensive in a way, in a market that's volatile. So, you can see there's a lot of boxes you can tick with Woodside. And like I said, for a dividend pay investor that's looking for the dividends that are fairly lowish risk, I think Woodside is a very good one. For a little bit of growth as well, possibly over the next 3-5 years, I think also you're looking at Woodside. So overall, look, I'm liking this. Come back. It's not too expensive. So let's go back and have a look at the actual numbers now. And you can see probably like I said, this year is an anomaly. It's been very, very strong. So P's dropped down significantly. Dividend looks fairly strong, but they've paid, like I said, extraordinary dividends this year. Let's say even if it's halves by next year, or even goes down by 3/4, you're still going to get a decent dividend, probably about 5% to 6%, and you're probably going to get about a P of about 10. I think overall, really good company. Return on equity is excellent of 26% for a company of Woodside size. So look, I really can't make it too negative on this. This is actually pretty good. So I'm sort of turned my thinking of not investing into long-term type mining / oil and gas but this one I'm going to make an exception to. So for you guys, if you're looking for something like this, definitely look at it, put in your watch list. We'll look at it on Friday. It's starting to earn already from the $30, so possibly is your opportunity. All right, Claude, thank you so much for joining us. I'm not going to keep you any longer, so I know you've got something else to do. Again, thanks guys for joining us, and again, see you next week. Oh, sorry, actually see you tomorrow, but I'll see you next week at the same time, Claude. Thank you very much.
Thanks, Peter. Have a great day. And sorry, and thank you for letting me go on so long. I realized I went on a bit too long about all my 6 stocks then. So sorry about that.
That's all good. That's all good. I'm just happy I've spoken about Woodside, which is good.
Yeah, cool. All right. Well, I'm still keen to hear the Bitcoin discussion another day.
I will. I'll do it next week because I'm just probably maybe I just need another week.
Awesome. Have a great day.
Cheers.
And everyone watching. Bye.
Bye.